Well, just because you're no longer in school doesn't mean the grading process is over. Think of buying a stock, but want to make sure you're investing in the A-plus kid, or the A or the A-minus. You don't want the C-minus, right? Well, your prayers have been answered. Ratings company Egan-Jones is introducing a corporate stewardship and compensation analysis report. It's a fancy word, but wait till you hear how it works. It may help you decide really quickly whether a certain stock should be in or out of your portfolio. Joining me now, Egan-Jones CEO Sean Egan. We called you the lone wolf because as a ratings agency, you really call it like you see it. What have you compiled? I called it a dossier, a yearbook. What are you calling it?
We're calling it the CSCA reports, but whatever name, it still has the same objective, and that is to give a snapshot of where the companies have been, especially the management, whether or not they understand what's ahead of them, and whether they have the potential for delivering reasonable returns to investors.
You mentioned management. Does that include the board as well?
Absolutely. Oftentimes, the two are joined. That is, that the CEO selects who will be up for board nomination. And there's a lot of controversy when it doesn't come through the CEO.
You've assessed right now 60 companies. There are thousands of publicly traded companies in North America. But let's start with some where you looked at them. Not a popularity contest. You don't care. You're Sean Egan. What did you see? Give us 3 names of ones that you feel are not making the grade.
There are 3 categories where investors, in our opinion, have to be concerned. One is a change in consumer taste. For example, if you look at the Coca-Cola, the Kellogg's, they're having difficulty, the Procter & Gamble, because people have changed the way they're buying things and why they buy things. In the case of Procter & Gamble, it's not the nationally advertised brands that are as important. There are other things that people are looking for. In the case of Coca-Cola, they're not as interested in purchasing the carbonated sugar drinks, and you see that Coca-Cola's sales have leveled off. In the case of Kellogg, people aren't buying as much in sugared cereals. But that doesn't mean that these companies are doomed. It just means that management has to figure out how to address it. For example, Heinz has figured out how to address it. That is, they lower sales, they cut back expenses, they're doing fine.
Yeah, well, they were also bought by a private entity along with Warren Buffett.
Absolutely.
A lot of questions about where they go next. Right. But within these 60 companies assessed, 3 of them, you said, are at strategic dead ends. And, folks, these names may surprise you, but Sean is saying Apple, already mentioned Kellogg's, and Caterpillar are at strategic dead ends. Apple?
Let's deal with Caterpillar first, because Caterpillar is not alone in that category. That is, that they are threatened by the rise in the U.S. dollars relative to the euro and the yen. It means that the competitors have about a 20% cost advantage. That is a problem if most of your manufacturing base is in the U.S. And it's not just Caterpillar, it's Cummins, it's Harley-Davidson, it's a number of other companies like that. In the case of Apple, they're doing fantastically right now. Their rate of return was I think it was in excess of 40%. That is what they returned to shareholders. The threat is that what put them on the map before, that is iTunes, they're not a leader in that anymore. There's talk of the Apple TV. That was put to rest this past week.
You covered that.
Right. As of about 5 years ago, there's a term of crackberry, which indicated that BlackBerry was the dominant phone company, and it no longer is. And before that, it was Palm.
Well, it can turn around quickly, but for companies that you feel are killing it and doing well, Whole Foods,
right.
T-Mobile.
Right.
You also like Visa. We can put those up on the screen. And as we finish, Sean, I just want to ask you, you also look at management, and I think this is a very important point. Is management more interested in, not with these companies, but the ones that you're looking at and questioning, more interested in paying themselves than really improving the company and being visionaries?
They have to understand what their environment is and what the company can do. We refer to it as protecting and enhancing the franchise. It's sort of like when you're a parent, you're taught that each child is different. You want to do everything you can to enhance a child's potential, realize the child's potential. Every company is different, and it's important that they realize potential within their position in the market. And it's always different, and it's management's job to position it properly. Some management is just on autopilot, and they're paying themselves very well to do that.
It's great to have you, Sean. By the way, we're going to put this up. PRTG.com. Can we put that up on the screen?
Comp rating.
Comp rating.
Yes.
Okay, that's short for comprating.com.
Yes. Exactly.
But it's http://
Right.
Do we have it? There it is. Write that down, everybody, because some stocks you own may be on there, and you may not like what you see or may love what you see. Thank you, Sean. You're doing good work. Thank you.
Thank you.
Good to see you. Sean Egan, Egan-Jones, the